Oh, hey there. Yeah, welcome to Too Long It Didn't Read Finance Edition, where I'll be talking about some personal finance and trading with a little bit of a TLDR version up front. So stick around, like, subscribe, comment, and here we go. All right, welcome back. So today we're going to talk about what a SPAC is, or Special Purpose Acquisition Company. So these have been in the news a lot lately. In short, what it is just another way for companies to go public, and just a bit of a different way that we're going to get into of why it's different than a traditional IPO or initial public offering that's done typically through a large bank like Goldman Sachs, JP Morgan, etc. So so we're going to touch on all of these, and the TLDR, I'm going to timestamp it. It's going to be at the end. I just like to do it that way, kind of make sure I've got all the points touched, give you the best TLDR. And obviously, if you haven't noticed, my editing isn't great because I don't like to edit. I don't want to edit, so I'd rather just do it all through, give you kind of a recap slash TLDR later that you can jump to start or finish, whatever you like. So, um, a couple things obviously that are big. So the SPACs are one of their greatest assets is they're quick, or they can be quicker than a traditional IPO. So a stack in general is just a large chunk of money that's raised by a sponsor in order to purchase a private equity company or private company, excuse me, and take it public. They can also purchase portions of other companies. It doesn't have to be the entire company, but ultimately that's what they're doing is they're raising these blank check companies. That's why they're also known as blank check companies, um, because and part of the reason they are quicker is because they don't need a lot of scrutiny. They don't need a lot of SEC due diligence because they're not a company. There's no books and records. There's no product. There's no history of it. It's purely getting set up to purchase another company. So why are people investing in nothing? Hundreds of millions, billions of dollars sometimes for it. And so SPACs are actually very um, rooted to the individual, the sponsor themselves. So anyone could technically sponsor a SPAC, assuming you have the money, because you do have to put in some of your own skin in the game, potentially millions of dollars. Um, and that can get loaned to you and that sort of thing. So I could start one. I don't want to, obviously. That's a lot of headache. I don't know what I would buy, and who cares about Matt Burkhardt? But um, Bill Ackman is a good name. He's a big hedge fund manager now. He's done a couple. Chamath Palihapitiya, I think is his name. He's been in the news a lot lately because he had a couple of great successful ones like Social Finance, and some others coming out as well. I think Clover Health was another one he did that didn't go so well, but still did pretty well. Still positive. But it's all about the name. So Buffett, even Tony Robbins, even though he's not a finance guy or hedge fund manager, that sort of thing, he could start one because he's got a name, he's got a brand around it. People would trust that he's going to do it right, and that's what it is. And so you start off initially with, okay, I think Chamath is going to buy, or when he's looking for the company to buy, it's going to be a good one. So I'll give him however much you want to do, $1,000, 100,000, a million, what have you, and you're going to get shares in turn, typically SPACs, when they're not a company and they're just this blank check, this holding fund, they're issued at $10 a share. And each share, once the acquisition of a company happens, I'm sorry, they're not shares. You can think of them as shares, but they're called units technically, because a unit is a share and part of a warrant for future growth if you want to buy more shares later. So a warrant just gives you the ability later on, some point in the future, or any time in between, to buy a stock at a given price, similar to an option, but not quite. And so with SPACs, the warrant can be typically half of a share or even a third of a share is more common, but they can be one full share. And then those warrants usually are 11.50 a piece. But again, the prices can range. These are just the most common. And so I give my $10,000 to Chamath. Chamath says, "Great, I'm going to hold on to this for up to 2 years." A SPAC has 2-year time frame in which to find a company to invest, and along that time, the money is just sitting in an escrow account, using government bonds, so very safe, earning a little bit of interest. The company typically, or they need to invest at least 80% of the client funds. Typically, it's closer to 95, 97%, because there's not a lot of fees in that, but they can use some of the money raised for fees, registrations, expenses, anything like that, to do the due diligence to find the company to purchase. And ultimately, sometime in 2 years, they're buying something. So in Chamath's example, he bought a good chunk of social finance, SoFi, and they have to buy usually a large enough chunk to avoid the Investors Act of 1940. And so typically that's a controlling share, so 50% roughly, but it doesn't have to be 50%. It can be, if it's a larger company, then it can be 20, 30, some 15%, but it has to be a chunk of the company as far as dollars, really as much as the fund can spend. If they don't purchase a company in that time frame, the investor is entitled to get their money back, usually made whole or at least some prorated amount based on what the expenses were. But it's typically, 90, 95, 99, even though, even what you paid, potentially a little more because of that interest. And it's not going to be like you bought $10 a share, you're getting 20. It might be 9.50, it might be $10 and a penny, something like that. But so it's pretty, there's not a lot of risk on the investor for them not to purchase anything, right? So you gave it a shot, you're there, a year, 2 years later, you get your money back. Not the end of the world, you didn't lose anything. Um, However, if they do make a purchase, you as the investor get to vote. So maybe because they don't tell you, right? So Chamath says, I need $500 million. That's really all he needs to tell you for a SPAC. Sometimes they'll be a little bit more generous. They'll tell you, I'm looking for something in the technology space. I'm looking for something in healthcare. But typically it's just, hey, I'm looking to buy something that makes sense. And so you got to trust that person or maybe look back at their track record because most of these people that are starting SPACs are from the industry. They're executives from hedge funds, banks, that sort of thing that are maybe a little closer to retirement, trying to make a couple extra bucks, have the expertise, and are looking to bring a company from private to public. So if they go ahead and buy and you don't like what they bought, you were looking for a fintech, they end up buying a clothing manufacturer, you get to vote, and ultimately, if you don't want it, then you can tender your shares. They will, similar to if they didn't purchase anything, they'll give you your money back, or most of it, or some prorated amount, and then you're done, you're out. And your shares are then picked up by the sponsor and resold to other people or held onto by them, whatever. But you have an option to get out. You don't have to stay with them if you don't want. And then finally, of course, it can you like whatever. I don't really know if this guy thinks it's good enough for me. Sure. And then it goes public. Like I said, potential in a quick fashion. So SPACs can be ready to go in as little as 8 weeks. Usually 2 to 4 months is the average for it, whereas a traditional IPO, 4 months at least. Usually 4 to 6 months, and potentially even 6 to 12 months is not uncommon for an IPO because they have more SEC scrutiny. They're a business. They need the books to be gone over. They need the due diligence. SEC is, of course, going to be asking a lot of questions. Is there competition? Is there antitrust issues? So a lot more. That's why it takes longer to do it. And so you've got companies gone public. You now are the proud owner of some shares in XYZ company. Along with those warrants that you still have, if you want to purchase more shares of stock, you now have the ability to with those warrants. Or you can sell the warrants out on the secondary market as well, just as you would stock. They're going to be traded similarly for it. They'll have value that if you don't want it or you don't have the money maybe to purchase additional shares, you can sell those options to the highest bidder. So that's the basics of how the SPAC would work. Once IPO, it trades similar to a stock, similar if you bought Apple, Google, what have you. It's going to be just like a typical stock would be, and um, that's pretty much it. And then like Chamath, he's already got 4 or 5 SPACs in the works because he did the SoFi one or he's doing one, and it's once that's public, it's kind of it. So less due diligence on the SPACs, and it's really done by Chamath and his team or whoever the sponsor is in his team. There's not a lot of peek behind the curtain for the client, so you really are investing in his judgment. So that's the risk there, right? So yes, there's not a lot of risk of you losing your money, um, assuming you stick out the whole way or before acquisition. After acquisition, however, um, and this is kind of where the misaligned interests, right? So a sponsor They don't get paid any salary or you know compensation for the SPAC. Their compensation, their benefit comes from finding an acquisition in a deal, because if they do that, they're entitled to 20% of the shares, a 20% interest in that company that they're buying. So it's a huge chunk. And so it behooves the sponsor to find a deal regardless. And an example there is Nikola from before. So the guy was getting close to his deadline to make a deal happen, so he did. So instead of returning the client's money and saying, "Hey, we tried," that doesn't benefit him at all, right? He might be able to break even, but ultimately he sank some money into the deal. He wants to get paid. So it doesn't behoove a sponsor to cancel the deal or not make a deal. So typically they're going to buy something. Um, and again, the investor can bail if they want, if they don't like the idea. But in Nikola's case, he bought Nikola. A bunch of bad news came out about it. They were making the videos up that the trucks weren't actually powered under or going under their own power. They were just rolling down the hill. And then he even got GM to buy into it. And then ultimately, it's now a fraction of what it was at its height. Still a company, still around, still above $10 a share. And I've got a slide showing, I think, them later what their current price was. But just potential fraud. So because there's not as much scrutiny and due diligence as you would with a traditional IPO from the SEC, it is a bit riskier because of it. Investor pedigree and sponsors pedigree are different. Sponsor pedigree, it depends entirely on their pedigree, right? Do they have a good track record for it? What's their industry? If Tony Robbins were to come out with one, I'd be a little hesitant. Like, I love the guy, but what's his expertise when it comes to finding an investment or a company to buy and take public? So we'll see. But somebody like Buffett, maybe you're a Buffett fan, so you're like, I don't care what that means, selling, I'm buying. Um, Investor pedigree, because SPACs have become so hot, and the initial part of it, they may be short-term investors. They may not be ones that are as long-term as an IPO might be a traditional IPO, because traditional IPO you've got the roadshow where the company's going around generating hype, building you up for 4, 6, 12 months. So you're kind of invested a bit more potentially in an IPO, traditional IPO, than you would be a SPAC IPO. Typically, it's they're not buy and hold forever types of investors. It's shorter term. More certainty and uncertainty. So this is around like price and valuation. So with a SPAC, you pretty much know what you're going to get because you've already got the money, right? You built up this fund to buy out the company. Whereas a traditional IPO, you're shooting for a price at 20, let's say at the open, or whatever you want your opening price to be, but the market ultimately sets that. So you may not know the valuation of the price you're going to go public with until the day before. Sometimes up to the minute before it goes live, right? So it may be some great ones last year started off, maybe at a $20 valuation and then took off. So Snowflake was a good one. What was another one there? Maybe SoFi, but I mean they started off at 20 or so, and then their first trade went off at 100 or 200 or something like that. So that's a crazy misrepresentation of the valuation. Great for the company ultimately, but they didn't know beforehand, and typically if you don't know, that's not a good thing in company situations. Because of the fact that there's less scrutiny, they can move a little quicker, and they have the money available already. SPACs can, I mean, for a private company, if it was my company getting bought by a SPAC, I could potentially get more for my company from a SPAC than a traditional IPO launch. And that's a couple points. The big ones are the SPAC's already got the money and they need to spend it. They need to spend it, right? The sponsor wants to get paid. And also, because the sponsor doesn't get paid unless they make a deal, they're a little bit more willing and frivolous with the funds, right? Whereas the retail investor or the banks that are out there, they're obviously trying to get the lowest possible price that they can. So it's going to be a bit different as far as that's concerned. So from a private company situation, the SPAC's probably going to be the better bet, just purely on valuation, than the uncertainty in that of a traditional IPO. Oh, let's see here. Could get a better deal, higher price, expensive. So traditional IPOs aren't free of charges either. Usually the underwriting bank, JP Morgan, Goldman Sachs, Bank of America, is going to take fees that's agreed upon up front, typically anywhere from 1 to 7%. Usually averages about 4 to 5 to 6%, depending upon what it is. And then you've got SPACs that are going to take 20% of the sponsor, or the sponsor's going to get 20% of the shares for usually a very nominal amount. 25,000. I saw read in some articles, a couple $1 million in some others, but ultimately, if they're paying a couple million, 2, 3, 4 million, that chunk of stock based on the valuation that they're buying is probably worth, anywhere from 3 to 10x that money. So they're getting a great deal, huge chunk of stock, and that's why they do it, right? And so that's also why the SEC may start changing its rules around this, because of just all the potential profit and gains and fees that these sponsors are making. They've been around for a while too. I didn't mention that before, but they've been around since the 90s, and they started off with a bit of a bad taste in people's mouth because there was a lot of fraud going on. There's not a lot of due diligence to be done, so you could easily, give somebody, your $10,000, and they've raised 300 million. They go and buy a penny stock or some, terrible company that ultimately wasn't vetted, what have you, but they got paid and they got out, and then, and so back in the day, these were really, SPACs were, you know, in the same breath as penny stocks. And so obviously now it's got quite a bit more of a reputation behind it. It's doing some big billion-dollar deals in that in 2020, and even more coming in 2021. But all that is, just be careful, right? So it's not just because it's the new hotness doesn't mean it's ultimately the better thing for you. What else we got? We got Oh, so some companies are actually choosing, instead of additional funding rounds like Series A, B, C, or seed rounds, as a startup in that would normally do, they're actually deciding to go the SPAC route instead, and ultimately kind of taking, instead of giving away more equity, they're just taking it to the market and going that route. So it's taken away from growth equity firms and private equity firms, so ultimately, that's helping to funnel the growth in SPACs because now you've got even more money coming, into SPACs from these equity firms because we're like, okay, we raised $1 billion to go buy, help a couple of startups, and they're going public via a SPAC. Well, I guess we'll put a couple hundred million in a SPAC, or create our own SPAC, and go that route. Lastly, poor long-term performance. So in 2015 and 2016, there was about 33, um, SPACs that went public, and over the last 5 years, they've on average done 3% less than the market, than the S&P 500. So not ideal, and of course that's not of every SPAC. And I think SPACs are getting, more, impressive, and there's more diligence being done, as we continue to grow. Um, or the number of SPACs continue to happen. But ultimately, over the long term, at least the last 5 years, SPACs didn't do all that well. Now, if you look at the numbers on the next page, we're coming up here of, stocks that have done well, or sorry, SPACs that happened in 2020. Almost all of them are over $10, where they started. So obviously that would be a great return. They were much higher at certain points because obviously you get that excitement of the IPO when it first launches. And some people, drive the stock up to 100 or 200 or whatever. I think Snowflake's, over 300 something dollars now. So that one was obviously a really good one, and that'll do really well to hurt, or mess up and bring the average up of, SPACs over the last 10 years. But, at least so far, right? Historic returns aren't guarantees for future progress, but, um, so far, I think it's just getting better. If you look at what's happened in 2020, stuff coming up in 2021, there is more due diligence, there is more money, there's more smart people getting involved with these. So hopefully that poor long-term performance will start to turn around. Just to break down, so we've already mentioned a lot of this between an IPO, traditional IPO, and a SPAC. SEC scrutiny, so it's a lot less on a SPAC because there's no business, there's nothing to scrutinize, there's nothing to do due diligence on. It's literally, okay, we believe in Chamath, and we gave him $500 million. Um, that's it. There's really the only thing, the SEC is making sure is that the money's sitting in an escrowed account so that he can't run off with it, and that he's sticking to the rules of a SPAC. He's got the 2 year timer or time clock going, and ultimately he's doing his own valuation and diligence to find an adequate company for them to buy. Time frame 4 to 6 months plus. Not uncommon to see a 12-month IPO process. That's not terribly common, but it is definitely something that happens. SPACs, as little as 8 weeks, usually no more than 4 months, just because there's not a whole lot to do. And they can spend that 2-year time frame doing all the due diligence on the acquisition target itself. Talked about price valuation uncertainty. So again, traditional IPOs may not know up until the final minutes or the day before of what their valuation is actually going to be. They can state a price. They usually don't that far in advance. It's a lot of just, hey, we're going public, and that could happen. It could be an 18-month roadshow process where they're building hype for the company, and then they could post at 20 and it drops to 15, and they could post at 20 and it shoots to 200. So no, not real sure of how that's going because it's on the public market. Valuation for SPACs, obviously, they can pay a little bit more because they've got the money. They want to do a deal, otherwise the sponsor doesn't get paid. And they know their valuation up front because it's just a negotiation between the SPAC and the private company. Whereas the IPO is the private company and the bank, and then all of retail and institutional investors. So lots of extra parties, lots of hands, etc. Investor types, you've got a bit more of a longer term hold type mentality with a traditional IPO type investor compared to the SPAC investors currently. This may change, but if I was an investor at Snowflake from $10 and it hit 300, I'm probably selling at least some of it, if not all of it, and seeing what happens next. I'm pretty happy with that return. Costs again, 20% of the SPAC shares are going to go to the sponsor for his help and effort to make it all happen. And then they're also paying some fee, usually a smaller fee, to a bank to help for the actual IPO, the acquisition to take the company public. So the SPAC is separate. Chamath goes out, says he's going to raise a couple $100 million. Takes him usually a lot less time, a couple days of meetings instead of months of meetings to raise the money. And then somewhere in that 2-year period, he'll find a company, and then he still has to call Goldman Sachs, JP Morgan, Bank of America, and say, hey, I need your help to underwrite these shares to take it public. The fee there is going to be a bit less because he's done a lot of the money. It's not the bank raising the money. But still could be a couple percentage points on top of all that for it. And then costs for the IPO, of course, to do traditionally straight through a bank, anywhere from 1 to 7%, depending upon the size of the deal. And you're investing in, so the traditional IPO, simply you're investing in the company itself directly, right? You're investing in the shares of Snowflake and their management team and their financials and their reports and fundamentals. In a SPAC, you're investing in the sponsor. You're investing in Chamath or Bill Ackman or Tony Robbins if he started one, or Warren Buffett or me. So those are all the big differences there. Top 10 SPACs of 2020. So I wanted to show this just because some names that you might recognize, and then of course Nikola was on there too. But Nikola's still above $10 a share. So if you bought it at 90, ouch. But if you bought in early during the SPAC time of 10 or 11.50, and I think it even went public at 20, then you're doing okay. It's not the end of the world, especially for a company that had a lot of bad press. But then DraftKings has done 60. Snowflake was another one that went parabolic for the most part in there. And then of course you've got ones like Allied Sports that are now down to $2. That one wasn't any bad news or anything. Well, they had bad earnings. Yeah, so just prices of how things are going, a couple months to almost a year later for some of these. Upcoming SPACs for 2021 to watch. Obviously, there's a lot more than this. I think last I heard there was 70 or 80 SPACs raised $23 billion in January alone this year to ultimately try to buy something in the next 2 years. So, but these were ones that started maybe even 2019, but definitely in 2020, and they're looking to actually go public. They raised the money, they found the acquisition target, and now they're looking to go public sometime in 2021. So to wrap up, the TLDR version, the recap, what is a SPAC? So a SPAC is a fund or an amount of money raised by a single individual, a sponsor, could be an individual person or a team from a private equity firm, to help take a private company public, usually in less time, 8 weeks, 2 to 4 months versus 4 to 6 to 12 from a traditional IPO. Less due diligence because it's a blank check company. A SPAC is, right. It's just all they're doing is they're raising money and they're going public with the money first. So the SEC doesn't have a lot to scrutinize because there's no history, there's no books, there's no product, there's no service. Um, and so because of all that, just the speed at which they can go to market is great. And then they've got 2 years after they go to market to find a company to buy, and then take that company public via typical underwriting means with a big bank. Um, and then they're expensive. The sponsor of this SPAC that buys Bumble, Robinhood, Snowflake, whoever, gets up to 20% of the stock as founder shares. And then that's how they're getting compensated. If they don't find a deal in 2 years, the money goes back to the investors, minus some fees and that, but usually prorated. And they're earning, while that money's sitting in escrow, waiting for them to find a deal, it's invested in government bonds, so they're making a little bit of interest. But ultimately, that money can be used for expenses, for fees, for research, due diligence from the sponsor. And then if no deal happens at the end of 2 years, or they just decide to close early, that money prorated back to the investor. So a little bit less risk from the investor. The investor gets to decide and choose if they like the deal, whatever the acquisition target is, because SPACs don't usually tell you ahead of time. They raise the money and say, I'm Chamath. I need $500 million. I got you guys. And that's really, typical for a SPAC. They might sometimes give you an industry and tell you like, hey, I'm looking in tech, fintech. Hey, I'm looking in healthcare. But other than that, you may not know what the acquisition company is until they know. And so that's a bit of a risk there. But yeah, that's pretty much it. That's the TLDR. So thanks for watching, and until next time.